Okay, well, fantastic. Thank you very much. My name's Mandy Mannix, and I'm really delighted to be able to moderate this panel. I've got some exceptional panelists here to share their insights, but before we do that, I want to do a couple of things. First, a shout out to Rahul Mudgal and his team at iConnections for putting these events together. I understand last year the iConnections team called this Funds for Food to look at raising money for a fund for food security, and they raised just shy of $2 million, which is just so fantastic. So to see this year it being Funds4Minds, when mental health is just such an critical issue around the world, I think generally, but obviously, as we know, exacerbated by the pandemic, I think it's probably fair for me to say that I speak on behalf of all of the panelists here that we're just really pleased to be able to play a role in that. So thank you, iConnections and Funds4Minds. Terrific. I hope lots and lots and lots of money is raised. So I mentioned that I've got an esteemed panel. I'm really excited to be able to moderate this group. I think the blend of expertise, knowledge and insights we have here in terms of the Australian market is unparalleled. I'll start with David. David, you're a director at the Conexus Institute. It's really interesting because this is obviously an institute that's both independent and not-for-profit. And so I think in a world where superannuation is compulsory and often gets pretty heavily politicised, to have that sort of independence is terrific. And the experience you bring to the Institute is clearly much wider than hedge funds. But for this group, interesting to know that you spent 12 years at CFS GAM, now First Sentier, running their hedge fund of funds. So that would have put you really in the centre of hedge fund land at its peak. I also note that you were the CIO at SunSuper. So again, very deep frontline hand-to-hand experiences as running a superannuation fund. Again, that brings some great insight to this panel. And then finally, managing or teaching the hedge funds elective at Macquarie University's Applied Finance Centre. So talk about all different angles there. I think people will be very excited to hear what you've got to say. Now, on my top right, I don't know what everybody else sees in terms of the panel order, but we have Kevin, the CIO of Energy Super, soon to be merged with LGI, so becoming I think $8.7 billion today. Kevin, you run, and that's going to be substantially bigger at $30 billion when you merge. And we know that consolidation in the superannuation industry here in Australia is a big deal. So you'll have that first-hand experience and a journey, I'm sure, that'll be interesting to go on. But I loved getting to know you a little bit, I love some of the humour you bring, because I think, having been both in a hedge fund manager myself, as well as been inside allocators over the years, and also having the good fortune to lead some capital introduction teams. I love the way you say you did 3 years on the dark side in investment banking, and I think there's probably a lot of people in the audience who can really associate with that comment. But you've been in the industry for a long, long time, 25 years, and as we know, 25 years is probably the extent of most of the excitement in the hedge fund space. I know they've been around for longer than that, but the real excitement over 25 years. You're running about 300 million in hedge fund strategies now. That's come down a little bit, and we'll save some of the insights you'll share on that for later on in the panel. And then I think the other comment that you made, which resonated with me, and I loved it, is this capital introduction event is very different to some of the cap intro events we've all been a part of in history. And while I think this is very cool doing it all through Zoom, I personally look forward to a day when we might be able to all head back to Bermuda and play golf and have a few bottles of champagne. But maybe I'm alone on that. Finally, down the bottom, Laurence Marshbaum, SunSuper. I mean, I think I said this to you, you guys were, some of the pioneers really of pension funds, superannuation funds, investing in hedge funds. So, both your own experience over, more than a decade, as well as I'm sure the experience you have just by being a part of SunSuper is fantastic. You've got $3 billion you're managing at the moment, so pretty sizable whack of money there to put to work. And what's I guess really pleasing for you is you have this charity that you built, a founder and chairman of 10 by 10, which has given $3.5 million or more to charities, grassroots charities across the world, which frankly, Laurence, is phenomenal. And I guess today being you're a keen supporter of, is it Batia? I hope if I haven't said that right, Batia. An Australian mental health charity being supported as part of Funds4Minds. So that's really special. So enough for me. I hope that's given our audience enough of an insight into the experience we have around the screen rather than around the table. When we all got together, so this is a message for the hedge funds listening in, we thought that what might be helpful before we kick off today is to really put the Australian market into context for you, give you a little bit of an understanding of what makes up the market and how it works, because it is a big pot of money and it is something I think that a lot of people around the world for many years have been interested in. And so we asked David Bell, given his experience and position in the market, to take a few minutes and really paint that picture for you before we get into some Q&A. So I'll hand over to you now, David.
Thanks, Mandy. Thanks for the introduction, and thanks to iConnections for the opportunity to contribute today. So as Mandy, you've just outlined, I provide a bit of an overview of the superannuation industry and how it flows down and what are some of the implications for allocations to hedge funds. So the industry has just ticked back above 3 trillion Aussie dollars in size, which is edging towards about $2.5 billion US in size. And simply put, Australian employers, pretty much for every employee now, following some recent changes, will allocate 10% of an employee's salary into a superannuation fund, which is effectively a preserved accumulation account, which you can access broadly at the point of retirement. And at the moment, the range of retirement solutions on offer is sort of still developing. There's a standardised retirement product, but there's probably more in the pipeline to come, which is a pretty exciting area. Now, the large majority of assets are defined contribution. Defined benefits sort of in most segments of the marketplace stopped a decade or two ago. So there's just a tail end of assets there, but the go-forward model for Australia is defined contribution. We have a peculiar model in Australia whereby you can actually manage your own superannuation and set up your own account, which is called a self-managed superannuation fund. And there's about 600,000 of those in Australia, and they make up just under a quarter of the assets. So they tend to be a bit more prevalent amongst high net worth individuals or households. So that means there's about $2.5 trillion of institutional assets sitting in superannuation. They're around, to paint the universe for you, there are around 100 sizable of note institutional super funds, but there's a fast rate, even though sometimes in Australia it feels a bit glacial, but there is a fast rate of consolidation occurring. And once a couple of present consolidations complete, about 13 superannuation funds will be running around 80% of the assets in the industry. So you can start to see that consolidation really taking hold. The regulatory environment is constantly evolving in Australia. Just as an example, a dot point for you, there's been about 25 reviews of superannuation in the last 10 years, reviews of different forms. And there will be more to come. And so it's just a constantly ongoing industry with regulatory evolution. And it's partly because now it's such a big pot of money. They just want to make sure that it's got the right direction going forward. Present regulatory environment is characterised by a focus on fees and reasonably basic measures of performance. I think the spirit there is that if you're a person who's conducting policy review, fee savings always feel more certain than outperformance potential. So I think that's one of the largest themes which drives a lot of the regulatory direction. And so we have a prudential regulator who effectively runs a publicly accessible, what they call their heat map, which is a matrix of different metrics. And that's starting metrics relating to investment measures of investment performance and measures of fees. And yeah, that is publicly available, is accessed by the media a lot, for instance. And so you are seeing that, which has only been in place for about 2 years now, starting to drive a lot of behaviour amongst funds. They don't want to be characterised as a red fund on this sort of traffic light style heat map model. Now, further to that, there's an additional set of reforms on the table in front of Parliament at the moment, and they're known as the Your Future, Your Super reforms. And central to those reforms is a single performance test, which is a metric-based test. And the metric effectively tries to estimate your alpha or your implementation performance. So they've provided a list of benchmarks which they use to try and map to the various assets in your portfolio, and then they measure the difference between your tailored benchmark and the performance of your portfolio as your measure of implementation. Now, it's very highly controversial, this test, and if I look at it through the lens of hedge funds, it poorly measures the performance of the hedge fund allocations that you may have in your portfolio. Number one, because it's difficult to benchmark hedge funds. As you know, hedge funds are all doing different things. And basically the way it works is that your hedge fund exposures fit into a bucket called other, so the licorice all sorts at the end, which might make up the tail of someone's portfolio. And that benchmark there is broadly 50% stocks and 50% bonds. Yet there's probably no single hedge fund that's targeting those types of allocations. And the way different groups are using hedge funds is probably very tailored to a particular purpose in their portfolio. The second thing about the performance test is that it ignores diversification benefits. So it's largely an alpha-focused test, and it's risk agnostic. And so that means that some of the other benefits of hedge funds, the way they can be used effectively to manage risks in portfolios, is sort of not captured in these tests. So it will be controversial if this test goes through. It, to be honest, is in front of us at the moment, and it's probably reasonably likely that it will go through. And so that will significantly change the landscape. We'll talk a little bit more later, but about the role for hedge funds going forward, because obviously I'm painting a little bit of a bearish picture here, but there is pathway forward. But that's probably the right point to stop there on the overview, Mandy, and hand back to you.
Thanks, David. That was excellent. And you're right, that just gives us a long and wide platform to cover the numerous topics that are going to be important for the hedge fund industry around the world in terms of tapping the capital here. One of the things you said and has always been on the minds of frankly anyone trying to come to Australia or considering coming to Australia to raise money is just that this Your Future, Your Super thing does kind of get people to think about costs and fees. So I might just pose the first question to Kevin, which is, as I said, Australia is really known for being fee sensitive. I've heard some people call us or refer to us as cheap. Is that it, or is there more to it? Like, how do we, when we're thinking about fees, give us the proper picture?
Sure. So, David's talked about the regulatory environment, but, there's also a competitive environment. And, regardless of, what we all think, as investors in terms of, focusing on, net of fee after-tax outcome for members, because that's what goes in their pockets. Most superannuation funds, unfortunately, will compete on a fee basis. So, that means that as a starting point, most funds will have a range of fees of what they want to spend. Funds will typically also have an allocation to more expensive asset classes, which are easier in the trustees' eyes to invest into. So, for example, things like property infrastructure, because keep in mind that for a lot of funds, trustees are still making the decisions. So, these fund trustees come from a wide range of places, but, for example, property and infrastructure are relatively easy things for trustees to approve. So that leads us on to, how do we invest into hedge funds and what's the approach? A lot of funds, from as I've just described, will have different approaches. So in a perfect world, in a competitive environment, hedge funds would come here and just sell us, their products, and they'd have a flat fee structure, but that's not going to work. So, I can talk about our experience, and we will look to invest into, higher fee paying strategies, whether it's hedge funds or private equity, infrastructure, property, whatever it might be, because as a relatively small fund, we can still write tickets of, say, $100 million, and they still have a meaningful impact. But what we are certainly looking for from that fee perspective is probably greater alignment. And what I'm saying there is that, for example, we don't want to pay fees on committed capital. We only want to pay fees on invested capital. We don't necessarily want to change the overall fee, but change the shape of the fee. So, for example, a lower base fee and potentially a higher performance fee. So that, at a given expected return, we get to the same fee outcome. So we just want a bit more alignment there. And lastly, payment of performance fees, upon the ultimate realisation of an investment or a closure or a fund or something like that, rather than getting paid, through the journey. Because, and we've all seen this, we've seen lots of hedge funds, make truckloads of money, bank big performance fees, and then they're underwater. And they look at it and go, well, I'm underwater now, I'm never going to make that back, and I'm going to close. So I'll leave it there. Laurence and David might have different views, but that's the way I see the world.
Go for it, David.
Mandy, just to bring it to life for the people offshore watching this, it's really important to be aware that the fee debate and the commentary on fees is now a very populist issue in Australian society. So you actually had the Australian Treasurer will frequently come out, and he uses a line that the amount spent on fees by the superannuation industry, which is roughly $30 billion, which if you think about, that's roughly 1% of that $3 trillion number, is more than Australian households pay for their electricity and water. So it's a very, it's a line that tries to take a percentage-based issue and convert into a household sort of reasonably populist type of rhetoric. And so that's the issues that are sitting over the industry. So it's going to be hard to see how fees could ever possibly go up. And if now that they've been converted to a dollar number and related back to households, you can see the ongoing pressures for those fees to come down in the public eye and probably in the media eye.
Yeah. Laurence, did you want to share anything on that?
I think that's enough on fees. I think the challenges are well represented, and I'd concur with Kevin. I just feel if you're a global manager and you're coming to Australia, just understand the structure that David's articulated and Kevin's articulated before you say, oh, well, shouldn't you be focused on on returns? Net returns the most important. Like that rhetoric, which I sometimes hear managers say. It's like, yeah, like we get it. Like Kevin and I get it, but that if you say that, it displays an ignorance toward the structure of the market here. And so understanding the structural nature of the market, which the guys have articulated, would be a prerequisite before any conversation with an Australian allocator.
Yeah, I love that's great advice, because as you say, it's you or your trustee board that have to face the members to the point you're making, and they're seeing these huge numbers of fees. And so you don't need arguments from a hedge fund manager. You need assistance to put that in a way that makes sense. So I'm sure that's really great advice. Laurence, I'm going to turn the camera to you now for a little bit. As I said before, SunSuper has been a pioneer. So you've been, one of the longest standing investors. Your super funds being one of the early movers and longest standing investors in hedge funds. You've recently shifted your allocation, and I think in your words you said you've been public. So there might be some people out there that are going, oh my God, is SunSuper getting out of hedge funds? Which was, we saw that when a couple of the endowment funds in the US made some public statements. Share with this audience, if you don't mind, what are you doing? What are you thinking? And where's your head around at the hedge fund space?
It's not as sort of blanket as a SunSuper's out of hedge funds headline. So let's immediately dispel that from from any potential headlines. It's just as you articulate, it's a little bit more of a shift. So if you think of the challenges that that the guys have presented here in terms of understanding the structure of the market, and you think about our portfolio, which is trying to deliver absolute return outcomes to our members, and we've got a fixed fee budget. And traditional hedge funds, not only in terms of the fee reporting requirements, the regulation that David was referring to, one has to disclose the management fees, the performance fees, and the underlying trading costs, which basically, I think, in many respects, rules out lots of hedge fund strategies like long short equity trading or heavily or macro strategies, which have a lot of trading, a high trading component, because the underlying transaction costs associated with those strategies and leverage and so on and so forth really takes the fee load of those underlying strategies beyond what we can afford to pay in terms of our fee budget. And so when we arrived at that challenge, here's the fixed amount of fees we can spend, here's the outcome we're trying to achieve, which is really an absolute return outcome. How do we as allocators solve for that problem? And so for us, that's been a shift away from trading-based strategies where I think ex ante it's harder to underwrite what the absolute return or performance is going to be, to strategies which we think are slightly more opportunistic, and we pivoted more towards specialist credit and co-investments, which really take the view that banks have been stepping back due to increased regulation as owners or lenders towards certain assets, and how can we as longer term capital step in and be that provider of capital through our managers. And so our portfolio has really shifted away from being a traditional fund of hedge funds to being more having a much larger specialist credit and credit allocation, whilst doing a lot in co-investments as well. We've invested over $1 billion in co-investments alongside our managers, which is another way for us to control the fee load whilst having underwriting return outcomes with a greater degree of probability. So that's what that's really been the shift in the approach here, and our benchmarks slightly shifted as well to reflect that change in the portfolio. But I think that's also a good opportunity. I think in terms of specialist credit, private debt strategies have generally, I think, been underfunded here in Australia, and so it's sort of fallen traditionally in between the cracks between private equity and fixed income. And so, we certainly think that it's been is a decent opportunity. It's one that has so far done well for us.
Okay, great, thank you. Does anybody else want to add any comments to that before I'm not going to move away from it, but I would ask perhaps you again, Laurence, and then Kevin after. Does that sort of nuance shift mean that hedge fund managers should be thinking differently about the way they position their strategies when they come into the market to talk to you? And if that's the case, how might you guide them?
Sure, absolutely. Well, I can only sort of say how we work with the other hedge, the hedge funds we're still invested with, and that's like we've set up large fund of ones, and we have a separate, effectively a fund of one vehicle which acts as a co-investment vehicle alongside the manager's main fund. That provides us with an opportunity to co-invest alongside the manager in their highest conviction positions, or some of the highest conviction positions at a significantly lower cost, which blends the overall fee load down for us. And the managers being understanding of that. We think co-investing works for a few reasons. I think generally managers are over-diversified. If you speak to a manager about what their top best ideas are, I think they're generally like, got a few best ideas, and then the rest of the portfolio tends to manage the tail quite effectively. And so therefore, if we can optimize for owning more of what the manager's best ideas are at a lower net cost to us, and solve the problem of being over-diversified across a range of hedge fund allocations for us, that can help us achieve our return outcomes. And so when managers are open to that, when managers come with structures which can allow us to achieve our own objectives within our portfolio, that works for us. Before I start fielding calls from every single underlying participant in iConnections, just to be clear, like we only tend to do co-investments with managers that are on platforms. So you have the structures in place, the funds of one in place with your existing managers, and you execute by them. We're not in the business of sort of going out and just entertaining new co-investment ideas from a range of different managers. We execute co-investments through the managers we already have relationships with. And I think that's important. And we're also not trying to game the manager. We're not trying to say we're not trying to cherry pick their best deals and not invest in their fund. We understand it's it's a give-take relationship. And so therefore, that's the way we've built out, our co-investment program. And as I said, we've done over $1 billion of co-investments. And so for us, that in terms of some ideas around structures that tend to work for allocators, for us, that's an approach that's worked for us.
Thank you. Kevin, any thoughts or ideas?
Yeah, no other comments except to say we're doing similar things, more so on the private equity, infrastructure and property side, but there's no reason why we couldn't do it on the hedge fund side. And to Laurence's point, it also gives us just meaningful exposure, because remember, in Laurence's case, he's going to soon have $200 billion. We're going to have about 30. So those co-investment positions give us some meaningful exposure to positions. So and that's how we think of things. We don't just think of it in the individual fund sort of sense. It's, does it make a meaningful difference at the overall optional fund level? So, yeah,
great, thank you. I'm going to open this to all, but I'll ask maybe David for if he has comments first. But there's a lot, and it's a little bit sort of linked to what we said, but takes a slightly different path. Just that the world of investing in hedge funds originally, a lot of that was to do with diversification. So we had all of these traditional relationships between equities and bonds that we felt we could rely on, and alternatives was a really nice way to build some diversification into the portfolio. There's plenty of talk about that traditional relationship having broken down. So any thoughts on hedge funds or alternatives becoming that, or being that diversifier, or just any thoughts more generally about how people can think about the nature of markets going forward?
I'm probably very happy to be researching and not investing in running asset allocation programs and thinking through the scenarios at play, because it's a pretty difficult environment. Obviously, there's a lot of momentum in markets, and there's some pretty obvious fundamental reasons underpinning that, Mandy, at the moment. But if you run any sort of scenarios-based approach, that scenario that sits there, which is a rising interest rate, rising inflation type environment, which there might be a catalyst for revaluations in equity markets, is a really tricky scenario to play out, because the traditional mechanisms of diversification that you've highlighted aren't there to sort of save you in that scenario. And so it's tricky because it's always a fundamental challenge. How much value do you put on risk reduction? The regulatory environment's not putting much value on that. There's a pretty strong mindset, well established, that in the accumulation phase, drawdowns aren't terrible because you have time to recover on those drawdowns over the longer term. And so you're actually seeing trends in the marketplace where a lot of super funds are targeting higher and higher exposures to risky assets. So there's sort of pretty established trends there at the moment. And but even there, the role of hedge funds and alternatives broadly in doing that, how well did they perform during the GFC in terms of providing that diversification benefit? It didn't quite turn out as well as it should have, or was anticipated back then. So, that's a fair while ago now. It's over 10 years. So next time round, it's going to be really important that the hedge fund industry, and the way people have brought their hedge funds portfolios together who are using those strategies, and breaking it down further to other sources of liquid alternatives, that they are doing their job and providing those diversification benefits. I think that then might need a proof of concept in a way to really re-establish the case for more money to be spent on diversifying strategies.
Yeah. Comments, Kevin or Laurence, you want to add to that, or?
Yeah, sure. I'll jump in. David touched on, and we touched on in our pre-recording sort of call, talking about liquid alternatives, and I think they were probably that sort of halfway house for investors, particularly investors in Australia, that thought we can get something a bit cheaper. It will provide us with something that looks like hedge funds potentially, and give us some of that diversification benefit. But as we now all know, or as some of us experienced, actually, the concept was great, but to be fair, I think it didn't work because a lot of these strategies didn't work because the investors are probably as much at fault as the managers. And the reason why I say that is because, you look back at these strategies and the back test, like all back tests, looked awesome. But equally, investors probably weren't skeptical enough, and probably, I think that we probably didn't understand what we were investing in at the time. So, by way of example, a lot of the strategies, these risk premium or liquid alternative type strategies had biases to value and quality, but a lot more value than probably what they expected. And a lot of investors have embedded value in their equity portfolios, and they both didn't work at the same time. So, I think there's probably still going to be a role for hedge funds in particular to provide that diversification benefit. There might even be a role for liquid alts, and for most of us on this, on this recording, we're all old enough to remember some of those old school hedge fund strategies, and I think they'll probably make a comeback in liquid alts form. Things like your index arb, stat arb. What else? Merger arb, and other sort of non-equity, relative value type trades that can be, replicated and, that have got plenty of capacity. And, they'll mix them up with, things like trend and global macro, but mostly that non-equity relative value type thing. And I think that's probably, someone will figure that out and go, this is the hedge fund light of the future, but I think there's still a role for hedge funds broadly, just in that diversification piece and return as well. Subject to fees, of course. And we haven't talked about risk or capital efficiency, but I'm sure we'll get onto that at some point.
Yeah, well, why don't we? Why don't you kick off a little bit about that? Maybe frame it, and then we can, take some other insights around the table. Because I think you just made everybody happier anyway. So, crack on.
Oh, look, I'm still living. I'm a dinosaur, right? I'm living in the dark ages. I'm ever hopeful of hedge funds making a comeback. So, one thing that we talked about, and David touched on in the introduction, was the APRA heat map. And one aspect of the heat map, which is quite important, is the fact that it assigns a level of risk or a definition of risk for every dollar you invest. So, for example, there's a definition of growth assets and there's a definition of defensive assets. So, hopefully APRA's not listening to this, but there is things like equities, for example. You put $1 in, it recognises it as $1 of growth assets. Equally, for defensive assets, you put $1 in, it assigns effectively a zero risk, or basically no growth assets. So things like credit, for example, lots of funds will be putting things like credit into their defensive bucket when they're probably more equity-like than anything else. But let's leave that aside for a moment. What it will also do, though, in that other bucket that David talked about is that, again, because it doesn't recognise the concept of risk, things like trend following, for example, which can be very capital efficient. Ordinarily you would invest in those things that say a 10 vol, you put $100 million in and you don't think anything more of it. But in that APRA heat map world, you want that capital efficiency. So you'll probably, for every $100, you'll probably have a 40 volt you could probably run on margin, and we want that capital efficiency. So that's something that hedge funds will need to think about, and when they're offering it to Australian investors, particularly that concept of capital efficiency. Now, obviously, that's tied to capacity, it's tied to fees, but there are ways around it. So, but again, coming back to Laurence's original comments, when managers come to Australia, they want to be thinking about this and get some boffins at a Big Four and get them to provide that overview of the regulatory landscape in particular to help them shape their products or their strategies to make them more appealing to Australian investors.
Awesome. Laurence, anything more? David? Maybe, David, can I just take that piece that Kevin just shared? One of the things we touched on, again, in one of our earlier conversations was just, so, okay, let's say you get one of the four, the Big Four to help you understand the regulatory market here in Australia, but actually there is two bits to the Australian market, isn't there? Because there's the future fund, which is very public, and then there's the I was going to say pension, the super market. So do you just want to share, because you had some good insights to just help managers position the Australian market in that sense as well?
Yep, sure, Mandy. So Future Fund is Australia's effectively sovereign wealth fund, and they're managing in excess of $200 billion, and they've done so very successfully, both in terms of total returns, but definitely in the concept of risk-adjusted returns. And they're provide a lot of autonomy. They don't have any of the peer group pressures that the broader superannuation universe has. So it's nearly endowment style in the way they run their models. And to be honest, their mandate's a bit more similar to the objectives of an endowment mandate to sort of fund future obligations and so forth. And so when you look at their portfolios are hugely different to what you're seeing in the superannuation world. And they don't have those fee constraints, and you are seeing really different allocations to alternatives, quite sizable. And everything they do is nothing direct, which is the other big trend that we're seeing in the superannuation world, the trend towards more direct investing. The Future Fund has to implement through mandates with managers or through external vehicles. And so you're seeing there that they are allocating a lot directly to hedge fund managers and the whole spectrum of alternatives. And for them, it has been very successful. I'm not there to speak on their behalf, but my understanding is that they're happy with the programs that they have. They're happy with the risk benefits that it's bringing as well. And so in a way, that presents the alternative model to the Australian system, but for superannuation. But whether we get there or not is a different game. But it means that, there is a pathway into Australia to a sizable hedge fund allocator, which for some funds might then allow them to have a presence and expand elsewhere.
Yeah, good nugget. Thank you. So the next one I want to just touch on, and this is for you, Laurence. There's consolidation in the industry, but so more larger pools of money to invest. And as we've talked about, there's challenges to find diversifying strategies to invest in and the like. But this audience, potentially, given its iConnections, there's going to be a lot of, either startup or early stage or managers that maybe are smaller, interesting strategies, but smaller. So could you just give us a few words, a little bit of positioning around the consolidation, the implications of consolidation, and then just some thoughts for managers?
Yeah, happy to. And actually, it wasn't referred to earlier specifically, although I think Kevin referred to it. So SunSuper is actually in the process of merging with QSuper, another Queensland-based fund around the same size as us. So it should take us to being over $200 billion, which would, be the largest, alongside Australian Super, would be probably the largest superannuation fund in the country. So it's meaningful in terms of its relevance in the context of the Australian market, in terms of the size of what this fund will be. The merged SunSuper QSuper entity. They haven't got an official name yet. The smart guys in marketing have figuring that bit out as we speak. But the challenge that presents to smaller managers is, if you're in my seat, obviously to be for us, we're running meaningful checks. So for us, it's not really worth it in terms of allocating to managers, writing checks, really under 100 million minimum, right? In terms of checks to new managers, when really our target size is significantly higher than that. And so therefore, as an earlier stage emerging manager, how do you sort of get access, or how do you get on our radar effectively pools of capital like ours? And I think that's going to be an increasing challenge in the Australian market as the market continues to consolidate and larger pools of capital continue to grow, because effectively larger allocators are looking for relationships with larger managers just because they can be more relevant for us. And so for us, the way we're doing it, obviously we've got these large manager relationships, large allocations, and then we do co-investments, and co-investments with those partners. I think for the US managers, developing relationships with some of the groups with whom, allocators like us might work. I'll speak openly, we've got a big relationship with BlackRock on the co-investment side, that's on our website. So they're in the market in the US talking to smaller managers. So if people come to me with stuff, I'll often refer back to them and say, look, have you spoken to these guys about that? So building relationships with maybe some of the older school fund-of-fund groups, which are now doing co-investments with whom Australian allocators may have relationships with. might be a good first step in terms of engaging with your own community and finding out who's access here. And then I think, aside from what I do, I think there's certainly opportunity on the, in the family office community here. I think one of the challenges Australia has is the tyranny of distance. We don't get access, and I'm fortunate. I've actually spent a lot of time working in New York for SunSuper. I was there for 2 years prior to COVID. We were looking at setting up our office there. And so I very much get the sense that there's a real disconnect that happens here geographically. I've also lived and worked in London in the hedge fund industry, and there's a real disconnect here. And so Australian allocators, more on the family office side and gums, can't get access to the same types of opportunities, as maybe our global counterparts here. And particularly now with COVID and with us being stuck in this COVID elimination bunker, which we, immediately look like never being able to leave, that challenge only heightens. And so therefore, how do you as a manager sort of get access and tap into that? That might be, a good opportunity for managers to think about accessing, smaller pools of capital here. But I think on the at the large end of town, I kind of see consolidation trend happening and larger pools of capital continue to allocate to larger managers. That would be my expectation of an ongoing trend.
Kevin, I'm going to ask you to add any comments.
Yeah, so other things, I'd make sure that, these groups, if they're newer, smaller groups, make sure they're set up as, proper businesses from the start. The days of investing in, 2 men or ladies or whoever, plus their pet and a Bloomberg, I think that's well dead. And make sure that you can, that you've got quality service providers as well that, will stand up to the scrutiny of, some operational due diligence. Again, coming back to fees, be prepared to lower your fees, but, the trade-off or the two-way relationship that Laurence was talking about earlier, well, in return, as investors, we should be, looking to grow like an evergreen relationship with these smaller managers so that, as they grow, we grow with them, not just in terms of the funds under management that we have, but, potentially, whatever else that they can offer. So, some groups may want, new capital for new products. We can certainly help with that and work with managers. The other thing I'd say in terms of, new strategies within, larger organisations, and, Laurence has talked about BlackRock. Well, if you're going to come to Australia and, try and offer the product at 150 and 20 or 2 and 20 or wherever the fee might be, probably turn around. Because, if a BlackRock can't cover the cost of an investment team and reduce the base fee significantly and change the shape of the performance fee, well, then it's probably time for us just to say, see you later, I'm walking away. Because if you've got, trillions of dollars under management and you really need that, 1.5% to run your business for a $100 million team, yeah, that's no alignment. We can walk. I can find another hedge fund somewhere else.
Yeah.
And sorry to anyone from BlackRock, that's not directed at you. Just talking about the, organisations that have, say, $1 trillion, because I've actually had those conversations, and it's like, oh, we can't, we can't discount the base fee, and it's like, you don't need the fees to run that team, let alone your business, right? So there's no alignment there at all.
Yeah, alignment being the key. David,
it's
just
all
before
about alignment. Because paying someone zero is really insulting, right? No one wants to get paid zero. That's insulting. But, if you're a $1 trillion manager, if you can't suck it up for 1% over $100 million, they're not the kind of group we want to work with. So sorry to anyone from BlackRock, it's not directed at you particularly.
David, anything you want to add to that, or?
No, I think on that topic particularly, Kevin and Laurence are at the coalface. They're making the allocations, so it's really important to hear what they've got to say on that.
Yeah, cool. And
the other thing is, sorry, I was just going to add. I'm not aware of too many groups here that are in the business of doing manager seeding. So I know that that a lot of allocators in the US might look at earlier stage managers and look to take stakes in the GP and get in the business of manager seeding. But from the allocator side, just to close the loop on your original question, mate, I'm not aware of too many managers doing that. I mean, we've kind of considered in the past, but never really gone down the line of doing. I think you kind of need big teams to be able to do that effectively. And obviously, like I buy the research that suggests that, in terms of I get that earlier stage managers can generate more alpha than larger mega managers. I get it, but at the same time, that doesn't solve the fact that I might be at any one time $500, $600 million underinvested. I need to get capital working large checks, and so therefore, 10, 20 million in a bunch of different managers just creates also a huge amount of workload on what, and we're a team of 4 here in my team managing $3 billion. So, we're already pretty stretched in terms of our bandwidth. So we're looking to minimize the number of manager relationships as well. And so that's the other challenge, that tension between the amount of time you spend in outcomes for the portfolio. So we just try and focus our time on where we can shift outcomes, and that tends to be with larger managers. But manager seeding, I think, as a strategy makes sense. Just I'm not aware of too many people down here doing it.
Yeah, look, we will consider it going forward. We think it's probably a space where, particularly if it's a lift out from a larger firm and they're going to a large firm, that makes it a little bit easier. But if there is a lift out, and I can think of a few in the last 12 to 18 months that have set up an institutional grade sort of investment management firm off the bat, that makes it a little bit easier as well. So, but they're probably the exception rather than the rule.
Kevin, you just opened the door there, mate, to a whole bunch of potential new emails.
Yeah, well, we've got to look. To be completely honest with you, that's probably one of the only ways that we can compete, right? So, we can't write checks of $2, $3, $4 billion, or we can in equity space, but in this space we can't. So, the only way we can sort of get some sort of edge is to probably start doing a little bit more of this, because we just don't have the same scale as you guys. But it's a benefit and a curse, right? At the same time.
Right.
Cool.
Mandy, can I ask a question?
So
please,
all inquiries, they're going to get directed through somebody else.
Go for it, Laurence.
My questions. Sorry, I know we're close to running out of time, but my question's for David. Are the uni students still enamored with this idea of hedge funds? Have all these TV shows like have billions and all, like are there more enrollments in hedge fund in studying hedge funds in university? Or are they going down?
Laurence, I feel like I'm the bearer of bad news constantly on this forum, but the course that I taught actually got wound up a few years ago. So there has been a full cycle there that I was involved in that course for 12 years, and they tried to create it into a broader alternatives, which I guess is a bit of a trend for the industry as a whole, that super funds, they're looking at the broader alternative universe, not just hedge funds discreetly. So I taught that for a long time. I thought, that's a nice time for me to step aside. So that was the life cycle on that one. But I probably would say that, having spent the last 9 years unfortunately studying part-time again, that there is a undercurrent of trend amongst young people to be involved in finance, to be involved in finance with purpose. So hedge funds remain very attractive from the intellectual challenge that comes with them. But there is this really interesting undercurrent developing where you're seeing a lot of young people want to be involved with a job that has purpose. So improving retirement outcomes, or contributing to a societal problem, or addressing ESG. So I know that's a little bit off topic, but it really is an interesting data point that I find fascinating.
Yeah.
Actually, Mandy, one thing David just talked about, which we talked about in our pre-panel, was ESG, and I'm happy just to touch on it quickly. I know we're running out of time, but from my perspective, and from an energy super and the merged entity perspective going forward, LGIA, ESG's historically just been seen a bit of as a hygiene factor, but I think on a go-forward basis, it's probably more of a must-have. We are told by our regulator, APRA, that we need to consider ESG from an investment governance perspective, and more recently they have come out explicitly and said to us we need to consider the financial risks of climate change. So if managers just talk about ESG and they just basically give us a report from MSCI or Sustainalytics, and it's not really, or not genuinely integrated into the investment process, that's probably a no from me personally. I'll give you an example. We have ESG through our government bonds as a starting point. So it's increasingly becoming more important, and it has to be genuine. So I think at some point, the good managers out there, irrespective of the asset class, whether it's hedge funds or other, they'll see probably ESG as a starting point, not just as a risk mitigant or a nice to have anymore. It'll be an opportunity. So I'll park it there. I'll let Laurence and David add any comments.
Yeah, thanks, Kevin. I mean, I might just wrap up, then hand it back to you, Mandy. I mean, and I think it's important in the context of this forum as well, that in terms of iConnections, and obviously we come together in support of vulnerable people in the community and people suffering with mental health globally at the moment. But in terms of, I think as an industry, we can't just say we're going to go and optimize and deliver the best returns and then do this little philanthropy thing on the side to cure ourselves of the own ill-gotten gains we might have in our underlying portfolios. There needs to be clearer alignment between the underlying investments that managers are making and the ESG outcomes that our members, as David sort of articulated, are seeking. And so the industry is shifting toward a greater focus on what the underlying investments are and how they align with our own ESG principles, the SDG goals, and the ethical nature of our underlying membership base. So I think, in the hedge fund industry, we can see a shift, and we need to see an uplift in standards to align ourselves with better social outcomes in portfolios, because that's what us as allocators are going to be seeking, and not just, make our 2 and 20 fees and then just give a little bit off to philanthropy on the side. But there needs to be a stronger and cleaner alignment between outcomes of underlying portfolios and social outcomes that we know our members want.
Well said.
David, I can't not let you add something if you wanted to put a final word on, or if you're good.
I can't. I mean, what Laurence said was really prescient. I mean, it's really well said that, you go through uni and you're taught that everything's black and white and rational and so forth, but to really focus on all the impacts that you're having through the activities that you undertake and integrate those into really well-made decisions is really where society is heading and where it should always have been at. But now these risks are becoming more and more clear by the day, and accounting for those risks and accounting for your impact is crucially important going forward. Yeah.
Well, and let me say that, normally people are worried about Zoom because you're not getting that sort of physiology of the people in the room. But I really felt the passion then from Laurence, you and Kevin, and it's really inspirational to know that the people that are allocating the money on behalf of the Australians are truly thinking about the responsibility you have. And can I also say that, over the years, I've known just so many hedge fund managers through the roles that I've had. And I think there's a whole lot of hedge fund managers out there that are equally passionate about doing good. And it's, we've obviously got in any industry, a group of people who are out for the 2 and 20, but I think we probably all know there's a huge number of people that are really smart and want to put that intelligence to good use. So, David, you said you made the comment you were a bit I'm going to say the Eeyore, the negative, but I don't think you were at all. I think that the hedge fund managers listening to this call would have been hugely appreciative of the picture you painted. What we've done here as a panel is we've shone a light on $3.5 trillion of money, increasingly getting in the hands of fewer large pools, although, Laurence, you highlighted there is other money in Australia to come and talk to. But I think that those messages of thinking through before you come to Australia, alignment of interests, as Kevin said, understand that there is a public that they might not be engaged with super the way we would love them to be, but they certainly are. It's a compulsory issue here. So having the hat on of the member and the trustee and understanding their perspective when coming in here is only going to be helpful to you building a relationship with these CIOs and other allocators. So we've gone over time. I've loved it. I could keep talking forever, but can I just thank you guys, all of you. I think you're awesome. And of course, if you want to say anything else, do so. Otherwise, we'll sign off.
Thanks to Rahul and iConnections from me.
Thanks, and I think thanks to you all for listening, and thanks to iConnections. I always like to see genuine good initiatives that connect the funds management industry with philanthropy and purpose. So congratulations for the initiative, and I'm pleased to have been part of it.
Yeah, well done, iConnections, and thanks very much, Mandy, for sharing, and enjoyed catching up Kevin and Laurence.
Thank you all.